good morning to all of you, and welcome to our year-end presentation financial year 23. We have the normal program going through the highlights of the year, but also covering the last leg of the year, Q4, that ended on the 30th of September, before we give more granularity on operations and finance, before we end the presentations on overview on the new year that we have entered into, being into Q1 24 at the moment. Let me start with the highlights of last financial year 23, where a year that we think that we have landed in a good way. This has not been a year without challenges, I must say, but we are very satisfied with the way that we have been able to handle these challenges and the way that we've been able to bring the company forward. Looking at the main financial figures, they are reflecting the good progress that we've had. Revenues are up 7% compared to last financial year, ending at 169.5 million. Adjusted EBITDA, excluding fair value adjustments, which is the measure that we are using, are up even more, 15% to 35.6 million, while our adjusted operating profit, excluding fair value movements, grew even more, 61% to 14.7 million. As it will stem from the comments from Septima later in this presentation, when she goes through the financials, we have had good progress in all the central key financial metrics during financial year 23. And given the market conditions that we have experienced during the year, we are very satisfied with progress that we have been able to achieve. It's a continuation of a journey that we have been on since the restructuring that we did back in 2020. And since then, we have consistently been able to improve our operational and financial performance quarter by quarter, year by year. And if you look at that period, it's a 3-year period now. We have increased our revenues with 60% in the period. But more important for us, our adjusted EBITDA, our earnings from the operations, have increased with 145%. This is a journey that we intend to continue, making sure that we develop the company to its potential. And if we look back on financial year 23, we definitely think this is possible, because the group's performance in the financial year comes on the back of good contributions from all the 3 business areas, despite that some of the business areas, especially advanced nutrition, which is the biggest business area, had considerable market headwinds in the year. During financial year 23, we also have taken steps to make sure that the group is better positioned and more efficient going forward. The big reorganization we have done is that both the activities towards the global salmon sector, but also the activities towards the global shrimp sector, now have been gathered under a common leadership. So we have one leadership for what we're doing in salmon, and we have one leadership for what we are doing in shrimp. And salmon and shrimp are the main species that we are working towards. This reorganization enables us to combine our offerings, utilizing our market infrastructure better, as well as our operational and administrative resources. And it opens up opportunities for us to take out operational and cost synergies. And this is definitely something that we will continue to focus on in the time to come. In the financial year, we have also been able to advance our main growth vectors, and I will come back to that a little bit later in the presentation. At the same time that we have taken honest actions on areas where we have concluded that the potential is not present. An example of that is the divestment of the tilapia breeding activity, where we did not see the potential to develop a sustainably profitable operation. So that was discontinued, at the same time as we made sure that we kept the genetic services, which is a profitable part of our business, and towards tilapia, where we see that we have a good opportunity to create good business. Lastly, on the on the highlights of the financial year, I would like to hold up the way that the organization in Benchmark has been responding during the last financial year. We have an organization that has shown ability to adapt to the market conditions and to execute on the operational changes needed to improve the performance. It's a great asset for Benchmark to have this organization, and I'm grateful for it. Moving on, a few words on Q4, the last leg of last financial year, just to give you a little bit more granularity around that. In that period, we are satisfied with the underlying operational performance in the group that has enabled us to land the quarter, but also land the year according to our expectations. But having said that, the financial figures of the quarter reflect the market conditions that we have been in, and the top line and adjusted EBITDA are a little down compared to the same quarter last year. In genetics, just to take this systematic, we have had a good last quarter of the year in salmon genetics. Even if we did not have the same extraordinary uptick that we had in Q4 last year. Q4 last year, our main competitor fell out of the market, and it created an extraordinary demand for us. And that is not repeated in our last quarter in financial year 23. But if you look beyond that, the development and the sales in the quarter has been to our expectations, and they're being good. Our advanced nutrition business, INVE, have been doing, I would say, well in the quarter, given the current challenging market conditions that we've seen in the shrimp market. The demand for shrimp, and I said this also in the Q3 presentation, the demand for shrimp as an end product has been down significantly during the year, 20 to 30% in the main markets, US and EU. The reduced production and the reduced stocking as a consequence of this has, of course, affected our demand for the demand for our products. But despite this, INVE has been holding up very well. We have a very strong organization that utilizes all opportunities in the market, and we are very well positioned when the market is again turning. In health, the last quarter is somewhat a disappointment, as the demand of Ectosan and CleanTreat occurred later this year than last year. This has impacted our numbers for our health business in the quarter significantly if you compare it to Q2 in financial year 22. Despite that we saw an increase in demand of Ectosan, the other offering that we have within the health business area, that partly was offsetting the delay in traction around Ectosan Vet and CleanTreat. The good news is that the demand for Ectosan and CleanTreat has showed up again when we now have entered into the first quarter of financial year 24. All in all, I think we ended Q4 in a decent way with an adjusted EBITDA of 9.2 million compared to 10.2 million in last year's Q4. And again, I should remind everybody that this year we have encountered market headwinds. Last Q4 in 22, we had significant tailwinds in all our business areas, which is the result that we achieved them. Moving on to give a little bit more granularity on the performance for the full financial year on the three business areas, and starting out with genetics, where we for the full year saw revenues growing 14%, driven by higher salmon egg sales. It has been a good year for us in salmon eggs, and the total volumes has increased by 15% to a record of 334 million salmon eggs sold globally. Never sold so many eggs in Benchmark, salmon eggs in Benchmark ever before. The main driver of our salmon egg business are our activities out on Norway and Iceland. When it comes to the third part of that business, Chile, where we have just entered into the market, it has had our special attention during the year, as we see as an absolute priority to get this part of the salmon genetics business also to become a profitable contributor, both to genetics but also to the group. We have made good progress during financial year 23, doubling our sales, but we are still not where we want to be. The good news is that the commercial progress continues into the new financial year, which will bring us closer to the target, making this a profitable business and an important addition to our genetics business. We have also been progressing our activities within shrimp genetics, even if when you look at the financial figures, it reflects more a commercial progress during last year. Focus has been to reset our genetics based on experience from the first round of commercial launch and to do the necessary reorganization of the business to make it more commercially viable. What we have done there is to right-size the business, but we have also align it with what we are doing on other areas towards the shrimp market under the leadership of Patrick Patil, who is leading our advanced nutrition business and knows this shrimp industry very well. So both the reorganization of the business, the alignment, and the reset of the genetics are things that we expect to have effect and are starting to pay off in the time to come. If you look at the financial figures for the full year for genetics, it reveals that despite strong development on the top line, we are flat year on year on adjusted EBITDA, excluding fair value movements for the whole business area. This is due to the effects of the two growth vectors that I just commented. Both areas as I said, really having our full attention, making sure that the effects they have no negative on our EBITDA are minimized and eventually turn to become positives. As I have referred to in the two latest quarterly presentations, we have experienced inflationary pressures affecting our production cost as well as margins in genetics. This has in particular been related to the cost of our harvested fish. What we see for the full year, if you look at the full figures, is that these effects are mitigated in part by good cost efficiency on OpEx and R&D. A key priority during last financial year was to ramp up our capability on new reproductive technologies in salmon and eventually other species. This is a very deliberate strategy, making sure that we are staying in the forefront of technology development on genetics, enabling us to bring forward genetics to our customers that could significantly enhance efficiency, animal health, and welfare. For us, it's also a clear target to embed technologies into our genetic solutions that enhances our ability to increase the value of our offering. It's no secret that the value we as a genetic specialist gets out of our products and solutions are low compared to the contribution these products are making, as well as compared to the total cost of production, especially in the salmon industry. The route to get away from this is to embed technologies that more clearly justify a higher value into the genetics, and that's the journey that we are on. So to this end, we have strengthened our genetics team significantly under the leadership of Ross Houston. We are also advancing our programs for reproductive technologies on sterility and gene editing. Under the highlights of genetics, just to have mentioned that, as it was announced, we acquired 10.52% as a minority stake in Benchmark Genetics Iceland last year. When we did that, we announced that the reason behind that transaction is to secure full ownership in the key salmon genetics operation that we are lucky to have on Iceland. This brings me to the slide where we show the breakdown of the contribution from the segments of our genetics business. This is a slide that we introduced some quarters ago in order to be transparent on how it's all put together when we're looking at the different parts of the genetics business. Not surprisingly, we see that we have a strong performance in our core salmon genetics business. At the same time, we see the negative contribution from the two growth vectors that I've commented already. Chile reducing its negative impact for the full year, while shrimp genetics business have widened the gap from where it should be. Both areas are really at our attention. and we expect that we will see results of the actions to show effect in the coming year. Moving over to the highlights of the financial year for Advanced Nutrition, or INVE, which has had a strong year given the market situation it has been facing throughout the year. Top line margin and adjusted EBITDA are slightly down compared to last year, but overall the business area is keeping its position from a good financial year 22. Again, the performance that we see in 23 is on the back of difficult market circumstances. We have a very strong team in INVE. I'm very proud of that. They have really been on all the opportunities in the market and made the most out of it, strengthening the market positions and market shares in the key markets. The team have also a great ability to adjust to reality, which is important. They have adjusted the organization throughout the year, but also showed great cost discipline. Both elements are reflected in the numbers we see on Advanced Nutrition for the year. The difficult market conditions in the shrimp market have been very much the focus on our presentation around Advanced Nutrition and INVE over the last year. But I should remind you also that INVE has a strong market position for its products and solutions also in marine fish throughout the world. And the biggest segment there being the sea bass sea bream market in the Mediterranean. In that segment of our Advanced Nutrition business, we have been doing well, not because the market has been particularly good, because it has not. But again here, because of our efforts, the relevance and the timing of the sales that we have had in that market segments. All in all, I think we have utilized financial year 23 in a very good way for Advanced Nutrition. Besides running the business, we have also strengthened our R&D efforts with new technologies coming online, one of them based on artificial intelligence, and new important R&D collaborations both in Ecuador and Singapore. And together with the strong organization we have in this area, we feel that we are very well placed to take advantage of the situation when the market again turns, and the market will turn. At last, a few words on what is our smallest business area, health. But despite it being the smallest, it is an area where we have put down a lot of efforts over the last 3 years. And we are now starting to see the effects of that. If you look at the full financial year 23, the revenues are up 27%, and our adjusted EBITDA margin now has reached 19%. This is a result of increased adoption of Ectosan wet and CleanTreat, which is the main product, but also a consequence of the combined portfolio between Ectosan as a medicine and Salmosan, which is the other offering that we have in that business area. Because in parallel with the push that we have done to get Ectosan wet and CleanTreat adapted and implemented into the market, we have also achieved changes in the marketing label of Salmosan that has made this solution more relevant and effective as a sea lice treatment. And this has been paying off in increased sales and contributions to our results during last financial year. As I mentioned in my general go-through of the highlights, Q4 was disappointing in terms of capacity utilization for Ectosan and CleanTreat in the Norwegian market compared to what we experienced in Q4 in 22. This is due to a delayed peak in demand for the solution compared to last year. As of now, having moved into our Q1, we have 2 systems in operation with good capacity utilization and better visibility for the period. As I've also been consistently talking about for more than a year, a key focus for us has been and still is to make the Ectosan CleanTreat solution more adaptable to our customers and less capital intensive for us. This work has been progressing well throughout last financial year, and it's still progressing. The aim is to get the CleanTreat system, which is capital intensive for us, integrated into the customer infrastructure, in future wellboats. That's the end game we have there. We continue to work with our partners, MMC and Salt, very good collaboration on this area, and still aim to sign the first contract making this solution come true. But in the meantime, we also look at other solutions that takes down our exposure of holding CleanTreat in periods with lower capacity utilization. We are now starting to get some experience on this, and based on the last 2 years' experience, we see that this will likely happen when we are moving into Q3 and Q4 in the year. Capacity utilization then is lower than in Q1 and Q2. So this is why finding solutions that makes us less vulnerable in this period of the year financially now is a key focus for us. As some of you probably have noticed from the media, the issues around sea lice, fish health, and fish welfare in the salmon industry is not becoming less these days. You see it in Norway, Iceland, but also in other regions. The fact that we are a leading provider of medicinal treatment for sea lice in Norway and other markets makes our portfolio of solutions even more relevant. We should be very well positioned, especially since fish welfare is very much in essence, and medicinal treatments that we are having are the most gentle and caretaking for the fish. So with those words, I leave it up to you, Septima, to go through a little bit more granularity on the financials. So Septima, the floor is yours.
Thank you, Trond. So as it's the end of our financial year, it's always a really good opportunity to reflect back on the journey that has brought us here. And back in May 2022, we put in place medium-term objectives to illustrate how we were going to be bringing the business forward, how we were going to build towards profitability and cash generation. And as you can see, we've made really good progress this year around these metrics. As Trond noted, we've made good progress on our revenue growth metric, even with challenging markets within our nutrition shrimp market. But ultimately, we still believe in the medium-term objective of the 15 to 18% revenue growth per annum on a normalized basis. But even with the reduced revenue growth, we still were able to maintain our adjusted EBITDA percentage margin at 21%, and ultimately still believe in the pathway towards that 25 to 30%. Very pleasingly for the business, we've been able to move our cash conversion metric up again this year from 33 to 56%, moving towards that 70 to 80% that we've previously guided to. And particularly pleasing is the fact that we've now moved to a positive free cash flow percentage of sales. And albeit it is only a positive percentage of 2%, moving from -8 to 2% is good progress for the business in the year. So moving on to look at the income statement. Some of the metrics on the sheet here, I will talk to later on in the presentation. So in the context of the revenue growth, so we achieved 7% revenue growth. And Trond mentioned the fact that we have experienced within our genetics business some inflationary pressure. But it's been very pleasing that within our nutrition business, we've been able, at a gross profit level, been able to maintain our gross profit, even in light of reduced sales, and ultimately grow the gross profit within nutrition and also within health as we grew that business area. We'll look at R&D later on in the presentation, but if you look at adjusted EBITDA, the adjusted EBITDA grew at 9% in the period. But more pleasing from a quality of earnings point of view was that the adjusted EBITDA, excluding the non-cash fair value element, grew 15%. And this is a metric which is more aligned ultimately with the cash which will be generated in the business. So this is particularly pleasing. In terms of the exceptional costs we have within the business, we've previously guided that the exceptional costs relate primarily to the Oslo listing. But within the fourth quarter, we also had exceptional costs around right-sizing our nutrition business so that it would be the right size for the markets in which it's trading, and then also the consolidation of our salmon business under one leadership. And of course, from a loss for the period, It's always good progress to shrink the loss from the 28.7 million down to the 16.1, moving in the right direction, but not quite there yet. Then if we can move over to the next slide. So looking at our revenue growth. So if we step back from our revenue growth, it's very pleasing for me that since Trond and I joined the business back early 2020, we've grown the business from having a revenue of 105 million to 169 million that we are showing now this year, a growth of 61% in totality. And as you can see, this is a growth on all levels. We've grown the health business through the commercialization of Ectosan Vet and CleanTreat, but also through increased use of Salmosan. We've grown our genetics business through our increased genetic salmon footprint in the main. And of course, we've grown our nutrition business, which, whilst has seen a slight dip in terms of revenue, overall has increased significantly in that period of time. Moving on to the next slide. Again, in terms of the adjusted EBITDA, we've grown it from the 12 million in financial year 20 to the 36 million in financial year 23, and ultimately have been able to grow the adjusted EBITDA margin always in the right direction. Most pleasing is also the fact that we've been able to grow the business on a relatively stable corporate cost base, which allows us to do more with the business as we grow and get better operating leverage. Moving on to the next slide. So focusing on that operating leverage. So when we look at operating costs, they have in totality grown for the business as a whole, as we have grown the business. But ultimately, the true lever around this is, have we achieved a reduction in the operating costs as a percentage of the sales? So have we grown the operating costs slower than we've grown the sales? So thankfully, we've been able to reduce that down from the 38% in financial year 19 down to the 30% that we see here. And that's a continued focus of the business, not to improve the cost, increase the cost base at a pace faster than we're growing the sales. Similarly, in terms of our R&D investment, as we've moved the business from being towards more of a commercially focused business and launched products, we've reduced down the investment that we have within R&D for the business. Within the R&D for the business in financial year 23, that's a tale of two stories in a way. What we have done is we've created better cost efficiencies in our R&D spend by bringing certain things in-house, certain competencies in-house, and ultimately getting better cost efficiencies. But at the same time, we have also increased our investment in people to allow us to expand out some of the research and development projects that we have in place, particularly within genetics and nutrition. But ultimately, the R&D investment has reduced significantly as a percentage of revenue within the business. So moving on to the improvement in cash generation. So it is really, really pleasing that we have been able to progress this metric, always in the right direction, moving from the minus 25 figure that we had from a free cash flow figure up to a positive figure of 4 in this financial year for free cash flow. And that is built on the back of better cash generated within the business, and then also better utilization of the cash within investment in working capital, as I'll touch on in a minute, and also our CapEx. So if we can move to the next slide. So from a cash conversion point of view, working capital is a very, very important part of the business. But Benchmark is quite a working capital intensive business in itself. As you can see, within genetics, the majority of the working capital is our biomass. It's our fish that we have within our production facilities. Ultimately, the source of all of the future income. Within our nutrition business, it's the inventory that we have of diets and health products, and of course, our inventory of Artemia, which is associated with our take or pay contract that we have with the Great Salt Lake Cooperative. Health is not quite as capital intensive within the working capital area, but we are aware of the fact that it is capital intensive in the lease and CapEx part of the business. But overall, this is an area for financial year 24 and onwards where we feel that there are things to gain. that there's opportunities for us to bring down the working capital and get better utilization of working capital within the business, ultimately allowing us to convert more money from the business into cash. But fundamentally, taking the working capital as a percentage of sales down from 55% to 45% is a step in the right direction. Then moving on to look at our net financial expenses. Within the period, there has been a real increase in our actual interest of 2.2 million. And that is driven in the main by the fact that we drew a revolving credit facility during the year, and also the fact that we've got a higher coupon on our bond in the period. This was offset by movement on our cash flow hedges in the period, and also some incremental FX gains and losses that we had in the period. Moving on to the next slide. Moving on to the cash flow. So as I noted earlier, when we looked at our operating cash flow, we have net cash flow from operations, which is before working capital and taxes of 29.6. What's very useful this year around our cash conversion is the fact that we have a much lower investment in our working capital of 1.1. And then, of course, we have our taxes, which is 8.5, but ultimately brings us to an improved figure of 20 million net cash from operations versus the 10.8 million last year. And of course, with much more moderate CapEx this year at 6.8 million pounds, which is in line with where we previously would have guided CapEx for this financial year to be. And then also within the year, we had a couple of one-off items, which we will not expect to reoccur in the future. We had a one-off proceeds from a previously divested company of 1.3 million pounds. We had the equity raise of 10.9 million pounds associated with our Oslo listing. And as Trond noted, we had the acquisition of the minority interest in our Icelandic. But ultimately, at the end of the year, we're in a better position from a net debt perspective than we were at the start of the year. And of course, with cash of 29.3 million pounds and liquidity of 41.5 million pounds, that's a very solid place to be starting financial year 24. Then if we can just move to the next slide and just a quick overview as to where we are in terms of our net debt. So we have, of course, our NOK bond, our 750 million NOK bond, which is due for maturity in 2025. We have a revolving credit facility of 20 million pounds, of which 7.75 has been drawn as at the year end. And we have the remainder of the debt associated with the Salton facility in Norway. But overall, and of course, we have our cash at the end of the year, which was 37 million. But overall, we've got a very solid balance sheet to move forward into the future towards that profitability and cash generation. So back to you, Trond.
Thank you, Septima. And moving over to the outlook in the year that we have now entered into, I would say that after a couple of quarters where we have been facing significant headwinds in some of our main markets, shrimp market being the main one, we sense now that we are moving into a somewhat better market landscape again. We have started the year well with good activity in all of our business areas. In genetics, we have good visibility of our salmon egg sales for the coming quarters of the year. Salmon egg sales are the backbone of that business. We expect to have a good year looking at volume, taking into account that the supply issues that were impacting us and benefiting us in Q4 22 and Q1 23 is not going to be repeated. No, our competitor has resolved his situation, and so we will not get the same positive effects that we had in those two quarters repeated. We saw that in Q4, and we will see that in Q1. But besides that, in the underlying salmon genetics business is moving along nicely with good visibility. We also continue to see good progress in Chile. I mentioned that earlier in the presentation. I was down in Chile last week, and I'm more optimistic than ever. Gradually, we are coming more online with sales. which will add to our salmon egg volumes in the periods to come. We are getting there, even if it takes us some time, and the strategic impact of having a complete setup that covers the whole salmon world, covers all the relevant markets, not only Norway, Iceland, and Europe and the land-based, but also being very present in the Chilean market, is an important strategic step forward for us. Our SPR shrimp activity is, as mentioned, reorganized and slimmed down in terms of organization and aligned under the same leadership as Advanced Nutrition and INVE. We expect to see the effect of this coming through in the coming periods, but it will still take us some time to get to the position we want to be in this area, but we have taken the grips necessary in order to move us there. Both the growth vectors in Chile and SPR shrimp or shrimp genetics remains a strategic and operational focus for us at the group level in the time to come, to make sure that we are progressing those growth vectors as good and as fast as possible. In Advanced Nutrition, we still face challenging market conditions in the shrimp market, but due to the strong efforts by our team in INVE, we start to see some signs of recovery. According to the most qualified external or objective analyst also on the shrimp market, which is Rabobank, they are confirming the downturn that has been in production of shrimp during the year that we have left behind and the situation we are in right now. But they also clearly expect a rebound in the shrimp production in 2024, and we are well positioned to take advantage of this when it occurs. In health, we have good visibility on the capacity utilization of Ectosan and CleanTreat in Q1. As mentioned, we continue to work on changing the business model to make it solution more adaptable for our clients and less capital intensive for us, and we aim to move this to a better place over time. This is a key in what we are doing at the moment. At the same time, as I mentioned, we are looking at ways to take down our financial exposure in the periods with lower capacity utilization, as we are with the setup we have now. Based on experience, those low capacity utilization periods are coming when we are moving into Q3 and Q4. On our Salmosan sales, which has not been talked too much about in previous presentations, are moving well in all our markets and forms a combined portfolio with Ectosan that we think will have even more relevance going forward, given the challenges the salmon industry is facing at the moment in terms of sea lice, fish health, and fish welfare. At the very end, let me just repeat why Benchmark, the last slide, is such a unique company, in my mind, such exciting company. We define ourselves as a market-leading aquaculture biotechnology company. Aquaculture because we are in a very exciting industry, young industry driven by global megatrends that will provide growth for those companies who are well positioned, and Benchmark is really well positioned in that market. Biotechnology because we have three good and independent but also interrelated business areas where we hold market-leading positions in what we are doing. It's a key to our strategy. We are in areas where we are market leading or convinced that we, on the basis of our capabilities, to become market leading. From these three business areas, we are providing highly specialized solutions. We are not in commodity. We are only in areas that command high margin. Mission critical solutions, meaning that the farmers need our solutions every day in order to farm. And all our products and solutions are having an agenda to drive sustainability in the industry through farming efficiency, animal growth, and animal health and welfare. And we provide our products through an impressive global distribution network. We have our own people on the ground in 26 countries. We are selling our products and solutions to customers in more than 70 countries every day. Truly an international company, truly a company with a very relevant footprint and presence in the global aquaculture industry.
Can you give us a little bit more detail on what delayed the demand for CleanTreat and Ectosan this year compared to previous years?
Well, good question. And we have been looking at that. In my mind, it has to do with, several factors. One of them being the sea temperatures around the Norwegian coast have been different this year. I think this year we have seen a little bit less sea lice pressure than we did last year. It will always fluctuate. This is nature. It will always fluctuate. So we were disappointed that we didn't see the same development as we saw last September, this September. But it has picked up again when we're coming into October and November. So it's a shift in the demand pattern. We were concerned in September, but less concerned when we moved into October. So we're picking up again. So this is nature, and it always has its fluctuations.
Thank you. What measures have you put in place in Chile to bring about profitability in the genetics business?
Well, several. First of all, I think we have done the groundwork. I've used that expression before, in terms of making sure that the facilities we have are of a quality and of a standard that makes us a high quality producer. We even got a disease-free compartment around our facilities there, which is an important extra value to the customers, that we secure, biosecure deliveries of genetics. That's part of it. We have in place a good breeding nucleus that is specialized for Chile. It's based on the breeding nucleuses we have, but it's a specialized breeding nucleus for the Chilean market. We have in place a very strong organization, and we just recruited a new leader to our activities in Chile. Berta Contreras, which is very well known in the Chilean industry for her merits. That is also very well positioned in that industry. So, but besides her, we have a very, very strong and capable organization in place. The thing is that when you are establishing a genetics activity in our region, like we have done in Chile, you have to do all these kind of investments at the beginning. Then you need to produce the first eggs. That takes a couple of years in order to do. Then even if you tell the customer that you have good eggs and they should be fantastic quality, they need to buy them at first. Then they need to try them in the production, and then they need to see the results. And then we can document what kind of quality we are having on our genetics. That occurred around spring last year, in financial year 23. And now we are building, a documented track record on the capabilities of genetics that we have introduced into that market, which the customers relate to. So the way that the conversations with the customers are going, it's changing. If you go back to the winter or back to January, February, March, April, the discussion was, to convince the customers that we were a serious player. Now the discussion based on the documentation we have on the performance of genetics in the market is more like, how do we fit in their strategy? Because they see that we are providing something to the industry that is a real alternative to what they have right now. So that's what we have been doing and will continue to do.
Okay, thank you. Within health then, we talk a little bit about the outsourcing CleanTreat timeline. We've got a couple of questions here. One's asking around the progress made on the outsourcing, and the other's sort of asking really, how do you, reduce your exposure in the quieter times while still making sure you can capture revenue in the busier times?
Yeah, let's go a little bit through the timelines, because they could be a little bit confusing. The ultimate goal we have is to make sure that CleanTreat is not in our books, not a financial exposure to us, but they should be embedded into the infrastructure of the customers. And the ultimate way of doing that is to embed the CleanTreat system into the new wellboats that are coming into the market. And what we have done there is to develop, a configuration of the system that fits into new wellboats. So that is already done. What we are doing now is, of course, to promote that together with our partners, MMC and Salt, into the market. So in future wellboats, that will come in. The thing is that selling wellboats, to build a wellboat takes time. So even when we sign the first contract of that, it will take time before that comes alive. So this is why we are focusing now on, given where we are right now, we need to find ways to mitigate the exposure we have in periods with low capacity, at the same time as we keep the high capacity in the peak season. Because the way it shows in the industry right now, in the main season, we are making good money and generating cash out of the solution, but we tend to use that cash when we are in the low season. So we are trying to find other configurations of the solution that keeps the high season and the potential of the high season, but limits the downturn in the low season when we have less capacity utilization. So that's the process we are in, and we're working on different directions in order to achieve that. But that's an important step in the intermediate before we are getting to the final solution, which is CleanTreat being integrated fully into customer infrastructure.
Thank you, detailed answer. Given the cost and perhaps the lower trading activity than expected on the Norwegian bourse, how does the board view the success of the move?
Can you can answer that, Septima, because that's a little bit on the financial side.
I think everybody at the board would feel that it's disappointing, but I think in some ways it also has to be seen in light of the broader macro markets in which all small to mid-cap companies are trading at the moment. We still continue to work on both exchanges to try and generate demand to generate liquidity. And so we see that there is a future for us to remain dual listing with the ultimate view to bring shareholder value to the shareholders through increased liquidity and increased demand, through fundamentally built on better business success, because that's effectively what we've been trying to drive towards. We've been trying to build businesses that are solid quality businesses that generate cash, that then the shareholders can translate that growth, that value, that cash generation into increased shareholder value. And that's the objective that we as a board have had for the last number of years, and we are still committed to increasing shareholder value.
Yeah.
Well, on that note then, the next question is, with the top line growth and stabilisation that the business has seen since 2020, what do you think will drive significant improvement in shareholder value in the next 3 years?
Growth and cash. That is the truth. That is the basis under which we have progressed this far. And we can see that through the medium-term objectives that we have in place and our commitment to them, and the businesses that we have underneath the umbrella of Benchmark being good quality, solid businesses, that we can generate the growth and we can convert that growth into cash. And ultimately, the truth will shine through that in the share price and in shareholder value, that quality businesses generate cash and create shareholder value.
Well, let's pick up on a few questions around that growth then. Did you manage to get any revenue from the disposal of the tilapia business?
No, we didn't. But what we did was we divested a loss-making business. So we stopped the burn, and we ended up, as a consequence of that, we did write off some intangible and goodwill assets. But for the most part, the objective was for us to spend money on things that will make us money in the future. And so that's where we ended up with respect to the conclusion of the review of the tilapia business.
Okay, thank you. What is the reason for John Esfandi replacing Laura Lavers on the board, and what will he bring to the board?
So Jonathan is now going to be the shareholder representative of J&E Partners, which is one of our very significant shareholders. Jonathan's an experienced finance investment professional, and we believe that he will bring, you know, the number of the depth of experience that he brings with him will be of benefit to Benchmark as an organisation. But we are thankful for the time that we had with Laura as well, as she was a great benefit to the board.
Thank you. For genetics, would you please provide an update on development of sterile fish?
Well, that's a program that has been going on for, I would say, some time now. I think we are doing good progress on it, but it's a stepwise approach. You know, we think that we have the technology and the knowledge around the technology in order to achieve that. But at the moment, we are, of course, testing, and we are shooting ourselves in on the technology, so it's as precise as it should be in order to be launched. You know, this is a process that takes time. It's a prioritized project for us. We don't expect that will be out in the market in the coming financial year, but we think it's an important step forward for us, as a first step also on other reproductive technologies for our genetics. So I would say good progress, but this is comprehensive and complicated technologies that needs to be tuned before we are launching it into the market.
Okay, thank you. When do you expect to see recovery in the shrimp market?
Well, it's a good question. If I knew that by the date, you know, I would like to have that answer in front of me.
Polish that crystal ball.
What I relate to is that, you know, if you look at analysts, this is not talking down on any analyst, but you know, if you look at analysts that has the best objective and best track record in analyzing the shrimp sector, it's Rabobank. And if you look at what they have been saying, you know, they have been confirming, you know, the slowdown in the demand and the production consequences of that we've seen throughout 2023. So, you know, that's what they've been seeing. What they are saying in the latest analysis is that, you know, they expect a rebound in shrimp during financial year 2024. Our view of that is that we are going to make the best out of the situation regardless of how the market is, and I think we have done that in a splendid way in advanced nutrition throughout the whole 2023. We are extremely well positioned in order to take advantage of the market when it turns, whenever it turns, and it will turn, you know. But according to Rabobank again, you know, they are expecting it to come back on track during 2024.
Why did the Q3 expected seasonal increase in sea lice treatment not materialize?
Yeah, that's a good question. We really expected that we should have a similar pattern as we saw in September. You know, if you go back to 2022, you know, we saw low season in July, August, then it was coming online in September. So we expected the same situation to occur also last Q4 in last September. It did not. It was shifted into October. So it has to do with the factors that, you know, it's you will always have seasonal variations. You have variations over seasons in given that sea lice is it's the nature's own sea lice, so it cannot really be steered by anything. It has a relation to the temperatures, to all kinds of things that impacts when it kicks in, you know.
Okay, Q1 last year in genetics sales were very strong. Do you expect to exceed this this year?
What I say there, we try to be very precise on this one. You know, Q1 last year, we still had the effect, the extraordinary positive effect of our competitor falling out of the market. We will not have a repetition of that extraordinary sales because all the customers came to us when our competitor fell out of the market. You know, we will not have that same effect, especially in the beginning of of Q1 this year. But if you look at the underlying normalized demand, it is developing fine. You know, we are still on a good path there, but we will not have the same extraordinary uptick that we had last year. That is embedded in our numbers for Q1 last year.
Last but not least, are you having any success in pushing through price increases to offset inflationary cost pressures?
We are doing that constantly, you know, wherever we can on advanced nutrition. I think we have been good at that, and also cutting costs and adjusting the organization in order to take away the inflationary pressures. We are doing the same thing in genetics. Their contract structure is a little bit different, you know, it's more like annual contracts, and we have like times when we are increasing the pricing with KPIs and other means of increasing prices. So yes, this is a topic that we are constantly pounding on every day in order to get, you know, to rectify for the inflationary effect, but also to make sure that we get out the value that is in our product.
Well, thank you very much for your time. Thank you to everyone who submitted questions and for joining us today. Otherwise, we'll look forward to hearing from you in 3 months' time.